So what leads you to believe that, because, yeah, there's a lot of people out there that's saying that there's going to be a pullback, that this, we've had some banks in the US fail, that this could be another 2008, but because there's so much debt out there increasing all the time, that it could be worse than 2008. But you're saying that potentially won't happen? Is that what you're saying?
No, what I'm saying is all in good time. So I think because everybody got so bearish, and right now you've got so many people on one side of the boat, that as the Fed gets closer to the end of tightening, and I think they're very close, or certainly the end of this round of tightening, they're going to pause. As that happens, you're going to see a lot of people have to scramble from that side of the boat over to the other side. I think we're going to have a buying stampede. And I think people are going to find out what is meant by thin markets, because with so many people positioned bearishly, and all, it's kind of the opposite of someone yelling fire in a crowded theater where everybody rushes for the exit. You have a stampede out. This will be a stampede into the market where they all recognize in a very short period of time, in a fairly concentrated period of time, that they're mispositioned and that they need to move over from being short or being defensive into being more aggressively long. And as they try to get back positioned long, and as you get short covering, you're going to have not a lot of, you're going to have to pay up to get those stocks, because you're all on the one side trying to buy from the very few people that are selling. So I think it can really move a market in a short period of time a long way. So that's what I mean by a melt up. And part of it is we are more than 80 years into a super cycle. So I define a super cycle as the long cycle between two depressions, and I think we're in the final decade of that super cycle. I think it goes on into the balance of this decade, and then we get another huge depression. But we're also in the 41st year of a secular bull market that started in August of 1982. I date it back to then as a secular bull market, because that's when interest rates and inflation began trending down, and that's really what drove the markets to many multiples of what they were back then, because you had back then 15-20% interest rates in the U.S. As they moved to almost zero back in 2020, the PE multiple moved in the opposite direction. So you started out this bull market back in 1982 with 7 or 8 times earnings, and you're now up around 20 times earnings, or were. And I think we'll probably peak out above that. So this is kind of the last hurrah of a 41-year secular bull market. And then on the other side of that, and I think that happens in the next 3 to 6 months. On the other side of that is what I call a global bust. And a global bust, by my definition, is something bigger than a recession, shorter than a depression. So it's not drawn out like the 1930s were. It'll all happen within kind of the speed of a recession. So most of it within a year, but it'll be the damage of a depression. It'll feel like a depression. There'll be a lot of financial dislocation, a lot of involuntary debt liquidation, bank failures, big bank failures. So we're seeing a little bit of that, obviously, with Silicon Valley Bank and Signature Bank. So, those second and third largest banks, U.S. banks, to fail in history. That's kind of what I call the shot across the bow, or the tip of the iceberg. And we'll go through this melt up first, and then I think you'll see the second shoe drop, not to throw out all these metaphors, but the second shoe to drop will be the bust. We'll probably be in recession soon, but then that will gravitate into or morph into a bust at some point.
Okay, I'm confused because you also said, it's quite confusing because you also said there's going to be a melt up, that all the money is going to be starting to pour in, and the shorts will be, that'll be over, and the longs are going to try and position. That
Yep, so
sounds to
first
me like
comes
the
this.
market's going to be on fire, but you've actually just said we're going to have a bust. So I'm confused.
Yeah,
Talk
so
to us
so
about
yeah,
that.
let me try to explain that. Because what the reason it's confusing is because I think we're going to have perhaps the biggest rally in history just ahead of us, the next 3 or 6 months, and then an 80% bear market and global bust right after that. So what and the reason is because everybody kind of positioned for the global bust starting a year ago, and now we're finding out that maybe there's no bust. Again, my view is that we're going to have a global bust. The marketplace is not going to be thinking global bust when they're buying stocks. They're going to say the Fed tightening is over, central bank tightening is ending, and this is the beginning of a loosening cycle, or the beginning, markets rally when the tightening ends. One of the things that I think, if you look back, it's really been about 18 months that we've been talking about tightening, because even before the tightening started a year ago, you go back 6 months before that, and there was plenty of conjecture about the Fed needing to tighten, that, the markets were getting overheated and the economy was getting overheated. So the market's been dealing with the fear of tightening for 18 months and actual tightening for a year. And that's been a huge headwind that was, big reason why the market underperformed last year. And that's coming to an end. So all of a sudden you lose that headwind and the markets are free to run. I don't think people realize how much that Fed, the fear of Fed tightening, and the fear that Fed is tightening too much, and the fear that that's going to lead to a crack up, all of that was what was weighing on the market. If the marketplace, if investors begin to sense, as they are, that the Fed is ending its tightening, or at least pausing its tightening, that will begin the rally, or take it farther. We really started this in October of last year, but it will, it'll move up to the next level. As this market starts moving above new levels and resistance levels, it's gonna draw in more and more investors. More and more investors are going to be nervous about being on the sidelines or being positioned bearishly, and they're gonna come in. As you probably know, markets move on momentum.
Yeah.
So you will see FOMO. You will see them. It's fear of what, the train's leaving the station. I got to get on board. So I think that's coming.
So it's just that the lemmings are just falling over, getting themselves positioned. But you're saying that will be a melt up, which is short lived.
Yeah, and it is important for me to say I am a forecaster. So I'm a strategist. So I'm forecasting. By no means am I endorsing, what people should do. I'm not endorsing the rally. I'm not saying this is sane. I'm saying basically this is what I see coming. Everybody has to make their own decision based on their own risk tolerance and how
100%.
nimble they are, whether they even try to play it, because there is, I think, a lot of negative coming on the other side of this. The reason I even think this is important to know is because the way psychology works, people will be all in at the top. If they aren't aware of what's coming, they're going to miss the rally, jump in near the top, and then get slammed as the thing goes the other way. So, people should at least understand. I'm calling for S&P to 6,000 or 7,000. 6,000 to 7,000 is my target. From here, that's 50 to 75% move in perhaps less than 6 months. That's unheard of. I mean, that would be historic. If you miss it, what are you gonna feel? What kind of pressure are you gonna feel when at 6,000 or 6,500, all the strategists on Wall Street are saying there's clear sailing ahead, get in, right? You're gonna say, well, I gotta get on, I can't miss any more. So if I'd rather you understand when everybody's bearish that maybe there's an opportunity, right, than to get bearish at the wrong time right at the top.
And that comes back to that contrarian view, doesn't it? Because what you're saying is, while everybody else is bearish, there's an opportunity, but when everyone gets hysterical, that's potentially when you should just And by the way, ladies and gentlemen, not financial advice. We don't know your personal circumstances, so please make sure you speak to your own financial advisor. This is just David and I talking about what we think potentially might be happening. And David is based just outside Boston in the US. So this is a US, it's a macro view. And I'm down here in Australia.